So, Michael Warren, London Metal Exchange. I've been at the exchange now for 5 years. History elsewhere includes PwC, IBM, and a lot of working for myself. The Metals Exchange, as most of you are probably aware, is 135 years old. And pertinent to this topic is a mixed venue exchange. We have a telephone market, the last open outcry market in Europe, and a thriving electronic market, and those three coexist quite happily. So I think this will be an interesting topic for us.
Thank you, Michael. Amjad?
My name is Amjad Khan, and I work for the Pakistan Mercantile Exchange as the Chief of Operations. Pakistan Mercantile Exchange, or PMEX, is the only derivatives and commodities exchange in Pakistan, established by the stock exchanges and some of the banks there. And I've been with the exchange in the last 7 years.
My name is Alexandra Foster. As John said, you might as well call me Alex, because otherwise it's far too much of a mouthful. For the last 20 years, I was involved in investment banking on the trading floor, either running sales trading, electronic trading, or market structure at various investment banks throughout the city. For the last 6 months, I've just joined BT Radiance to add some of that sell-side experience into a vendor environment. And what does BT Radiance do? We're the largest financial community cloud in the world, which is nice, and we have the pleasure of connecting many of you participants here, whether it be exchanges, hedge funds, buy-side investment banks, to be able to trade. So we really underpin all of that connectivity from pre-trade to post-trade, and hopefully right the way across all asset classes.
Nice job, thank you. So the panel today is really about multinational firms seeking to enter new markets. This includes buy-sides and sell-side firms, especially in some of the newer and developing markets. And a lot of them we see are pre-positioning to gain competitive advantage from other participants. On the flip side, we've also noticed exchanges creating local storefronts in foreign markets, or working with new vendors to propagate market data to take trade order flow from foreign markets and foreign market participants, and even things like remote membership, in certain exchanges. So the two really have similar goals and objectives, and I think that the three panelists here have very interesting viewpoints and are involved with those sets of objectives. So we have some questions. I'll pick on you first, Alex, since you went last. So BT Radiance, you have a lot of foreign markets. You essentially bring local market participants across multiple geographies. I know you guys have invested, hundreds of millions of dollars expanding the network. What is new on the horizon as far as new product offerings, new investments in new markets? Can you give us an overview of where your product roadmap and service offerings going?
In a word, yes, John, we're looking at lots of new geographies. It's really driven from demand from clients looking for either new geographies or new asset classes, particularly with regulation. I'm not going to talk about regulation because I'll probably talk about it quite a lot tomorrow, so we'll just leave that one out there. But in terms of product development, what we're really seeing is a need to interconnect venues on a worldwide basis, so that to basically feed that appetite to be able to get there. So we work with partners like Equinix and their data centers, as well as our own data centers, stock exchanges and market data centers, putting in HCNs and mini-pops there to create a venue presence and create a venue interconnect on a global basis. That's our Radiance Venue Interconnect product, where we're able to take market participants, whether they want to be in the US and want to be able to trade in far-flung countries in Asia, or whether you want to be in London and you want to be able to trade in Eastern Europe. So there's a real drive for demand for newer esoteric markets. With that, though, we are seeing a real demand for much more standardization. And so people want to be able to connect to new markets with standard protocols, with standard interconnects into those markets, rather than some of the APIs that we are seeing from some of the exchanges.
And are there new geographies, any recent announcements? Of course, public information only. Any expansion that you've done recently?
I think one of our recent announcements, and I don't know if the Qatar Stock Exchange is here, but we recently did a connection into the Qatar Stock Exchange. We've done various connections in Asia as well. There was an announcement out about what we were doing with the Australian Stock Exchange down with their liquidity centre down in Australia, as well as connecting in some of the other newer markets. We're working heavily down in Brazil at the moment, but I don't think some of that is public knowledge yet.
Thank you, Alex. And Amjad, I read that your exchange is seeing record volumes. I know that technology investments are being made, by your exchange. Are you seeing a lot of these surges as peak rates over just a short period of time, or are you seeing them really spread out through the day? And is there any technology investments or product offerings that you're bringing into the market to meet those higher volume demands?
Yeah, along with the volumes that have been rising, it's typical of any derivatives exchange. So since 2009, when we brought in the market makers, the volume has been, shooting up year on year. And we had to make adjustments to the system to cope with the new volumes, definitely. Prior to 2009, we were pretty hard pressed, and we had to change our technology because of the costs and everything. So we built really makeshift, bare bones sort of system in-house to cope with our own needs, and went live in 2009 and let the market makers come in. And since then, there's a continuous effort on the technology side. So you have to keep up with the increasing volume. The mark-to-market process is taking more time, so faster databases, faster processes, in-memory processing, change of infrastructure, change of servers, machines, newer technologies. So it's an ongoing battle, and we'll have to continue to do that.
Okay, thank you. And Michael, a similar story, record volumes in the LME. I know you guys just recently opened up access nodes into other data centers, and you're able to tap liquidity from other markets. Surges in volumes, are there things you're doing really to keep that momentum going forward? And are you looking at potentially extending your reach outside of Europe at some point?
Our reach is already well outside of Europe, in as much as 90% of our volume originates elsewhere. Asia is very important to us, to which end we've established a rep office in Singapore in the last couple of years. In terms of extending our reach, we already are connected to a global network which allows people access. But the reality, of course, in this low latency world is that wherever the originator of the trade happens to reside, the actual technology has to be close to our technology. And to that end, as you rightly allude, and I'm sure you know one of those data centers, we have recently extended our footprint into a couple of community data centers to enable low latency access, or lower latency access, straight to the matching engine. That's one of the many measures we've taken to accommodate what we're seeing as a ever accelerating trend towards more algorithmic trading. We've built networks out, we've taken this presence in community data centers, but most importantly, we've also done a lot of strengthening of the core systems. I heard on the previous panel people alluding to the need to have high availability, high resilience systems, which is what we've endeavoured to build. What we discovered in the process is that quite often your weakest point, or your weakest points in the whole order flow actually originates outside of your control. That there are systems you feed and that feed you that struggle sometimes to keep up. And I refer to members' own systems, traders' own systems. It's one of the areas where we've seen some quite calamitous behaviour, where people have adopted algo and found their own back office systems can't cater for the new order flow. So there's a learning experience across the trading community, not just the exchange itself.
Have you implemented any technology to detect algos gone wrong? Do you have some intelligence built into the platform too?
We have, and we're continuing to accelerate that. We're in the process of putting in a real-time compliance system which will detect aberrant behaviour. At the moment, we're a little behind the curve in terms of we detect it afterwards. in common with many exchanges, we impose an order trade ratio, which is not draconian and is designed only to stop the truly frivolous trade and protect the systems. We had some problems most recently, I suppose, around 18 months ago with the market data feed. And that was the, and I know you alluded to the same thing, that was the piece that was struggling to keep up. We've now got a solution to that as well. But it's an ever-increasing battle as the volumes continue to increase. The payload per transaction reduces further and further, ultimately to the one-lot wonders, as we refer to them. We'll get to a point, I'm sure, where it'll be very, very close. It is already very close to one in some of the most liquid contracts. But the algos continue. We're doing something this year which I think is truly exciting. It's going to be the most fun project we've ever undertaken, which is to build ourselves a true testing arena. We're calling it the arena. The problem with algo trading is the untested nature of it. That there is a common practice of plugging an algo in which has never been seen, never been tried anywhere else. Typically, it will lose money for the person who's plugged it in, but in the meantime, it can cause damage to our systems as well. The other consequence you see is what I referred to before, the back office system failing to keep up. And the third thing to think about here is that people will plug in an algo, buy one from a provider, under the fallacy that's instantly going to make them money. This, of course, is not the case. You have to drive these things. And I see a lot of members actually effectively handing the keys of their Ferrari to their 16-year-old son. And surprise, surprise, it crashes it. So we've got untrained traders on untested software. Why is that? And the reason given usually is that test environments are illiquid and therefore not a good paradigm for reality. That if you go and try and test your algo, there's nothing to test against. And there's a paranoia as well that if I do it in a naked environment, I might be picked off when I come into the real world because you'll be able to see what my strategy is. So the solution to that obviously is to provide a liquid environment. And we toyed for a little while with the concept of taking yesterday's trade and replaying it in a test environment, which would have been good, but not perfect, because if you adopt an aggressive strategy, you'd expect to move a price, and you can't move a predetermined price. So what we're actually going to do is deploy a number of our own algos that will be guaranteeing liquidity day in, day out. And I think that's going to be an awful lot of fun to do. A, we're going to see how these things work from the driver's side. But B, I think we'll get it. We've already had a huge amount of interest, not just from our own members, but from vendors of various associated technology.
Interesting. So a suite of pre-tested algorithms that
Correct.
we know interact properly with your exchange.
Absolutely.
Wow, that's very interesting. Thank you.
It's great to see an exchange coming up with their own algos. It's an interesting phrase, guaranteed liquidity. Though, sorry, wearing my old broker hat rather than my vendor hat. But I think where you talk there about people using unknown algos, one of the things that one ought to do if one's selling algos is that, as you said, you can't just, everybody thinks, well, they might have tried something out before. You really need to have that training. And it's very, very difficult sometimes, when you're there selling an algo to somebody, and particularly if somebody's at an institution where, they're a known institution. You don't want to offend people, but at the same time, you don't want to create market havoc. So actually, the training of people to be able to use algorithms is actually absolutely imperative. And I know in my old life, not my new life, one of the things that we definitely used to do, and I used to insist on, was make sure that, if we're selling an algo to somebody, then we would train the people to use that new algo. And then even if we made tweaks to an old algo, we would go in and retrain people, and then go back in a month later to see that people are using the algorithms in the right way, that they are performant for them, the client, but also that it's making the right sort of behaviours for the market as well. But very interesting that you're going to come up with your own algos.
Yeah, in America we have an algo detection algorithm called Flash Crash, which really detects someone that improperly uses an algorithm. It worked, it's been 100% effective. Well, there's some algos with some fantastic names out there, aren't there? You're right. I mean, you can take the most advanced technology, and if the users don't know how to tune the parameters of an algorithm, it's essentially a useless, or even worse, it's a dangerous tool. Alex, we talked this weekend on the phone about some of the newer markets and expansion and the role of FIX, in really knocking down borders to certain markets. And the fact that some exchanges are still using proprietary APIs, and that may cause some, limits of who can trade on the exchange. Can you talk to me a little bit about what you're seeing as far as the adoption of FIX or the proliferation of electronic trading in some of the newer and developing markets?
I think one of the things that we're seeing is that where newer markets have decided to have not only their own API but also have a FIX gateway as well, the take-up of those markets by international players has been much greater and much greater accelerated versus esoteric or newer growth markets that have just decided to adopt their own API. And it's quite marked in terms of the take-up. And so therefore my advice to any exchange out there that is really wanting to drive for growth and drive for revenue is about thinking about those standards, thinking about the message types and thinking about the language that they send the messages out. It is an international global market, and whatever anybody thinks, FIX is a real enabler for growth for exchanges. And where we have seen, from a BT Radiance point of view, we are message format agnostic, so it doesn't matter whether it is an API or whether it is FIX, but from a pure observation point of view, where we do see growth for markets, where we see real drivers, is where people have adopted FIX, and you see the take-up of those markets really grow. And one of the things that we are seeing as well, it's really nice to see, having been involved in the markets and seen some of the markets go, from open outcry to one-touch DMA. And for those of you that don't know what one-touch DMA is, that's the sort of fallacy that it is straight-through processing. But in fact, it was actually just somebody with their finger on the key, the return button for all of those trades. And seeing those markets go from open outcry to one-touch DMA to true DMA, it's great to see the progression from those emerging markets.
And Amjad, do you think it's inevitable that all markets will go electronic, or do you think that's overblown? I mean, can you tell me how far your markets have come and where you plan to take them?
Generally, that's true. But if you have an exchange that's trading local commodities and have a monopoly, then it's not necessary that you go electronic, because then you have your own market, and it'll be accessible to your own people. So you can get away with that. But people are now used to electronic markets, so might as well just do it. So for a smaller market, you could acquire something cheaper, not go something with very expensive. But the recommendation would be to go electronic from day one.
Right.
But for example, I know ECX in Ethiopia. They went live on an open outcry system, and they were doing spot first, and now they are going to do futures, and now they are looking into expanding into electronic infrastructure. So it depends. For many of these new exchanges that you are seeing in Asia, like ours, these are like, somebody put it in these terms, that these are derivatives exchanges of derivative exchange. So it's a second order derivative exchange.
Right.
And so they have to have that speed that CME has or someone else has. Otherwise they're going to fall behind, and that's not going to work out. So for us, it's necessary that from day one, you should be electronic. But in some rare circumstances where you're trading some local cotton, and you don't care what's happening in New York cotton, it might be okay to have open outcry system and continue with that.
And from the perspective of your exchange, is electronic trading more of a burden from a CapEx or OpEx model versus the open outcry or manual type trading? Or?
Well, I would say both have their costs. For example, if we had an open outcry system, we'll have to maintain a hall and a building, and access to that building, security for that building. So it ultimately amounts probably to the same thing.
Right.
But with an open outcry system, the brokers have to have much larger infrastructure. They have to hire more people to be present in the halls, and they have to have all that paperwork going on and everything. So it's going to be an onerous job for them
Right.
and ultimately increase the cost for the clients. So going electronic helps them more than it helps us.
Okay, so it makes the markets more efficient and may
Yeah.
decrease the operating or CapEx cost for the members
Yeah.
as well. Michael, I saw you nodding your head, but you know, you guys have you have the voice broking, you have the open outcry and electronic. Can you kind of explain the percentage of each and maybe advantages, disadvantages that you see?
It is remarkable that since 2001, when we first had some form of electronic trading, the death of our open outcry, the ring, has been predicted and continues to be predicted, but the truth is it's growing. It's not growing in percentage terms, but it's growing in line with the rest of the exchange. It's true to say it's a smaller percentage than it was historically, but it still for us has a vital function in terms of setting daily prices, official prices, and it's also, bizarrely, the place where a lot of more complex date swaps occur. And it's thriving at this point in time. Many experts, as I say, have predicted its demise. They've also predicted the demise of the telephone market, the voice broking market, again, very important. I suppose the thing that could damage the latter could be a change in regulation, in as much as a lot of the reason for the member-to-member telephone market is transparency, or rather a lack thereof. So a lot of the larger deals between the larger trading houses are done on the phone. The electronic, of course, is the area of most growth, and it's the easiest, I suppose, to understand from our perspective here, and the easiest to break into. But I think for us, the future for all three, subject to other events, is looking pretty bright.
And you feel like it's pretty well balanced, and there's advantages to each method.
Absolutely, and for us, it's a case of, you know, for the trader, it's a case of what they're used to, what suits the particular trade they're doing. Many of our members transact across all three markets with specific books, specific sets of trades.
Right. Yeah, and a point I've made is, you know, people have said that about Equinix, is you guys are replacing all the traders because data centers have lots of computers in them, but it's actually the opposite. A lot of the trades on the floor are originating from data centers. They're sent via FIX, you know, they're sent to the devices or the handhelds in the open outcry pit. So they're actually very complementary. There may be more risk controls, you know, there may be more advantages in clearing with trading electronically, but doing it on the floor in an open outcry.
And very
exchange.
importantly to the economy of London is that the open outcry also sustains a set of drinking establishments and other, which would otherwise be dispersed across the globe.
The pub factor, that's right. So I promised a Q&A break in the middle. Are there any questions from the audience? I noticed no one moved in as Alex requested, so. Sure.
Just perhaps make a quick point, if I may.
Sure.
Which is, we have a terrible habit of looking at everything as either or.
Right.
It's either electronic trading or it's not. And life just isn't like that. And if you look what happened with cinema attendances, you know, I remember when all these things came out, VHS and then DVDs, and everyone said, oh, it's the death of the cinema. Nobody will ever go to the cinema. I can't be bothered. Actually, it's wrong, because cinema attendances have gone rocketing, and it was the same with the high street. You know, along comes mail order shopping, and then along comes internet shopping. It's not to say they don't increase, but actually, it's not the death of the high street. And I just think sometimes we get into this terrible sort of thing about either or, and actually, it's much better to have a multiple set of choices that people can choose in what they want to do. And I think in a curious way, I know the LME is unique, but nevertheless, I think it's interesting that you're saying that actually it is a question of horses for courses, and some people will want to trade electronic, some people want a voice broker over the telephone, and particularly in the more complex contracts and tailored contracts, you're never going to be able to do that by electronically. So I think you're right, it's horses for courses.
Thank you. Any comments on that?
No, just if anyone else wants to take a microphone to say I'm right, they're more than welcome. Doesn't happen very often.
Any other questions? Alex, comment?
Just one comment on the fix thing. People who are speed conscious, they'll go with the APIs.
Right.
And people who want to go to like time to market conscious, they'll go with fix. All exchanges offer some sort of fixed connectivity. all brokers offer fix as well as API. And we were talking to RTS to connect our exchange. And I told them we have a fixed gateway, and you can simply get our document and do your conformance, and we can be live. And they said, came back to me and said, no, we have to have an API access because we want to be the fastest. So you have to provide an API access, only then we'll connect. So both things for different people.
Yeah, that's a good point.
No, I mean, I'm not disagreeing with you. I was talking about growth in those markets, and I think that we get het up with high-frequency trading, but I think one of the things we should start talking about, I think one of the things we'll talk about tomorrow on the technology panel tomorrow, is much more about high-performance trading, and I think there's a very, very good paper that's just come out by Fix a couple of weeks ago, and it's about Fix versus API, what you can do to really start to look under the bonnet, particularly using Fix, looking up under the bonnet, and actually really drive that high-performance trading. And I think we should start to talk in that sort of language. What you can do with switches, what you can do in terms of port mirrors, what you can do with Solus cards, all those sorts of things. Java versus C++ versus open source is a really, really good paper to have a look at, and it answers some of the things you're talking about in terms of API versus Fix. But Anthony, to your points about, is voice dead or is it voice only or electronic only? I don't think it's ever going to be that. People still like to buy from people, and and we talked about having a machine going off by itself. Well, machines don't work by themselves. People are always going to want to have that conversation, and particularly has electronic trading really sorted out the block issue? No, it probably hasn't, and I think there is still there are some quite innovative new solutions that look like they're coming around the corner that are going to be block type solutions, but they are actually going to be things that are going to be an amalgam of both electronic and voice, including an IP solution. And I think when that comes down the track in a couple of months' time, that's actually going to be quite interesting, because that will be a hybrid of both, with both an electronic and a voice component to it. So you should watch this space.
Yeah, and I think I could agree with both of you in that I think Fix has really eliminated boundaries or borders. So I think if you're looking for reach or broader access to your markets, and you're looking for buy-side order flow, that will arrive to the brokers via Fix, right? And the brokers may be using an API, they may be using Fix, but really Fix works for 90+% of the world that isn't just focused on lowest possible latency into the exchange. So one more question here. Amjad, as far as electronic trading and further expansion and potentially connecting up with other exchanges, we've seen a lot of, for instance, derivatives, exchanges sharing order books, across boundaries. Is that something you're looking at? Do you have some of those relationships now?
Yeah, we'd absolutely love to have something like that. But again, there are regulatory things. There are we went to Bursa Malaysia to list their crude oil palm contract on our exchange, and they said they had an exclusive agreement with CME. So we went to CME and told them that we would like to list this thing, and they said we have an exclusive agreement with Bursa Malaysia. So and it doesn't help them. I mean, there's no trading at CME in that product. Pakistan is the second largest importer of Malaysian crude oil. So it makes sense that we list it and we let our traders hedge their risks through the exchange. So I mean, we would love to do that, but I think exchanges are slow to move in that direction. But commodities lend themselves in a better way for cross-border sort of listing of contracts, because commodity is commodity. Unlike equities, where a lot of other information has to come in, and the other country may not receive that in time.
Right.
So in case of commodities, it's a good case in point. It can be cross-listed. There could be other arrangements. There could be liquidity bridges in between the exchanges. There could be market makers sitting in between the exchanges. And ultimately, it's going to help all the exchanges, connecting all these populations in these areas. There's a large number of speculators and people who are interested to trade in these products.
Right.
And there are, of course, other issues as well. Like in 2008, I was talking to some brokers in the US, in Europe as well, and they had issues with compliance, connecting into Pakistan and political situation and that kind of stuff. So because of that, also it becomes sometimes difficult. And then the regulators are going to go and see what sort of agreements you are making, what's the strength of your market makers or the exchanges, what's the nature of the contract. And once something goes to a regulator, it's like gone into a black hole. It'll never come back.
Right.
But on the whole, you're saying you're open to conversations with anybody here who's got commodities they'd like to dual list, and then I'll say I can partner with you and we can do the connectivity. I think it'll work quite well, Amjad, yes?
That's right.
There are other vendors too. Talk to them.
I think we've got a nice partnership up here, haven't we?
How about the metals market? Any other comments there, Michael? I know.
No, I think I have some resonance with what's been said, because I think in our view we see certain exchanges as competitors. We see others as working in harmony with us and able to extend our reach into markets we can't otherwise touch. So, for example, we list a mini contract dually with the Singapore exchange. And the reason for doing that is, and the reason we don't see that as a threat, is they have, it's yet to really take off, I have to say, but in the fullness of time, hopefully it will, they have connections into a retail market we otherwise couldn't touch. So our main contracts are really, for significant industry players, whereas at the craftsman level, where you want a ton or a part of a ton of the particular commodity, we can't touch that. It's a secondary market that we don't benefit from. By partnering with another exchange, clearly we can.
And is that what drove? I noticed you guys were doing educational seminars in Asia. Was that really driven by the cross-listing relationship?
We've been doing education for forever, because I think if you look at where our trade originates, it's not in the hedge funds and the investment banks. It is an industry. So the more you can educate people who are producers or consumers about the value of hedging, full stop, but hedging in metals specifically, right, the more liquidity we're going to see.
Okay, thank you. So Alex, we talked a little bit about developing markets this weekend, and I was wondering if you could highlight some of the markets where you're seeing demand. I know we talked about Vietnam and Malaysia, Mexico, Central America. There's consortiums like MILA, in Latin America and ASEAN. Are you seeing higher demand in certain markets around the world?
Certainly seeing demand out of Asia at the moment, and there's been tie-ups there. We've seen, the BRICS exchanges, they've done an MOU, so we're seeing demand for that BRICS MOU that we've seen signed recently. So demand out of Asia, the demand down in Latin America, both into it and out of it, is very, very strong at the moment, and seeing a huge amount of requests for connectivity in there. And then we talk about the either or of voice versus electronic, but the electronic train, and the need for data isn't stopping. So yes, we're seeing markets grow. Yes, we're seeing certain jurisdictions require more and more connectivity. But actually, the core markets, we're seeing the request for more connectivity, greater size of connectivity, because just the demand for data is growing exponentially. And there's absolutely no stop to that. And I think that, looking at the figures, you can see what Oprah are predicting. You can have a look and see what TAB are predicting, and look at the graphs. It's a huge number that people are expecting in terms of the requirement for data, regardless of asset class, through 2012. So one of the things that we're really seeing is for people who are connected to current markets is an increase in bandwidth, is what we're definitely seeing as the need for data just grows.
Right. Great. Interesting. Any comments from Amjad or Michael on that topic?
2 microphones.
Okay. We're down to our 2-minute warning, so I need to open it up. Any final questions from the audience?
I haven't preempted Simon Gibbs, BT Radiance. Alex, you mentioned about the demand for data, but isn't there also, from the other panel members as well, I'd like to know, isn't there also a huge demand for putting things in the cloud, like we're doing at BT Radiance? And would you like to comment on that?
Everyone will think that's completely placed, Simon. It is absolutely not, because people know that I wasn't due to be on this panel. So we'll just do the disclosure. Yes, I mean, cloud and cloud services absolutely growing as people want to move away from capex models and into much more OPEX models, and we talked about risk, we talked about data. We're seeing an awful lot of need for risk surveillance, those types of providers, which are newer providers to us, wanting to go into the cloud, and us being able to provide a SaaS-type model for those providers. The growth in cloud is just exponential. I hate the word cloud. It's a little bit overused, a little bit like dark pools. I'm not sure we would have all chosen that previously. I know maybe we should have prizes for if anybody can come up with a better word than cloud, but sadly we are left with that at the moment. But no, you are right, Simon. Yes, we are seeing huge demand for our cloud services at the moment, whether it be from current clients or whether it is from newer participants bringing newer offerings into the market. So it was definitely not placed.
I mean, as far as data feeds are concerned, clouds are just fine. But moving an exchange infrastructure or parts of it, there are questions about privacy, security, regulations, country data going into a foreign jurisdiction. So that sort of does not help. Although from a purely economic point of view, it might make sense that we have some sort of ASP model that exchanges can run off of a cloud infrastructure. And that could reduce costs. I'm not sure it'll really reduce the cost, but a case could be made. And especially for the smaller exchanges and brokerage houses as well, if they are offered something like this that you can a turnkey solution for an exchange, you can go live in just one day, all the technology is taken care of, that's the best thing to have.
Right.
But once the proposal goes to the board to outsource this to an American company or someone else, they're going to say, okay, give it to legal, give it to the regulator, and then wait for 5 years.
Right. Well, it's interesting because at Equinix we track interconnection, between different industries, and our interconnection from financial services into cloud went up about 70% last year. So it was one of the highest growth areas. So I can kind of second your comment there that cloud is. I think the overwhelming demand, though, is really around historical data. So this could be, data that's quasi-public. And I think that people want to run their simulations. They want to do back testing, right? They want to create these environments, but they need enormous amounts of data. So we're seeing that demand. I don't know if either of you have any comments about that arena.
I mean, there is no question cloud's on the increase. I think for an exchange, though, one of the challenges is to, when you're looking when you're trending towards zero latency, you need geographic certainty to provide that. Any cloud provider who says they can give you geographic certainty is no longer selling you cloud. They're actually renting you some space in a fixed data center. So I think that, with that exception, yes, the data, the latency, less sensitive apps, and certainly for test and development, we've extensively used the cloud. But I think there's going to be a challenge there on the things like the matching engine. I don't believe will ever make it into the cloud.
Right. Understood.
Do you think matching engines of different asset classes that are less time sensitive will go into the cloud, though?
What's a matching engine that's not time sensitive?
Well, sort of, if we think about some of the changes that we're seeing in the fixed income market,
right,
where you have much more request for quote maybe request for quote isn't the right expression to then use for around a matching engine. I just wonder with some of the changes that we've got coming up, particularly in the fixed income market, whether you could see that in the cloud.
The other thing that might help cloud providers, and there are others.
Oh no, there's only one.
The other thing that might help them would be regulation, because there is a sneaky little line in MiFID 2 talking about minimum order resting time. Were that to eventuate and latency then becomes it stops trending to zero, starts being a fixed quantity, then yes, cloud becomes viable again.
Good point. I think we're out of time, right? Okay. Well, thank you, everyone. Thanks, Alex. Thanks, Amjad. Thanks, Michael. Appreciate it. Thank you to our audience.